In a world marked by economic uncertainty and geopolitical tensions, today's top stories reveal how they are shaping our lives. From the Federal Reserve's critical decisions to the ongoing military strategies in the Middle East, these events are more than just headlines. Here are today's top 10 stories you need to know. In a significant decision, the Federal Reserve has opted to keep interest rates steady at a range of 3.5% to 3.75% for the third consecutive meeting. This decision comes amidst ongoing economic uncertainty, particularly highlighted by elevated inflation rates, primarily driven by surging energy costs. The most recent consumer price index indicates that inflation remains stubbornly above the Fed's long-term target of 2%, currently sitting at 3.3%. While the economy has been expanding at a solid pace, job gains have been minimal, and many large corporations are announcing layoffs linked to advancements in artificial intelligence, which is reshaping the job market. Analysts are closely monitoring these developments, especially as Jerome Powell's tenure as Fed chair approaches its conclusion. His anticipated successor, Kevin Warsh, is expected to face significant resistance from within the Fed regarding future interest rate cuts, which have been advocated by President Trump. The economic landscape remains precarious, and the Fed's decisions in the coming months could have profound implications for both consumers and investors alike. As inflationary pressures persist, the Fed may be compelled to reassess its strategy, potentially shifting its focus towards more aggressive policy adjustments. Investors and consumers should brace for possible fluctuations as the Fed navigates this complex economic terrain. Tensions in the Middle East have escalated as President Trump is set to receive a briefing on new military options concerning Iran. This briefing aims to address the ongoing deadlock in peace talks, which have faced numerous challenges over the past months. Iran's nuclear ambitions, coupled with its support for proxy groups across the region, have heightened fears of conflict. Analysts suggest that these military options could signify a shift in U.S. strategy towards a more interventionist approach, potentially undermining diplomatic efforts that have been in place since the Iran nuclear deal. The implications of this briefing extend beyond military strategy. They encompass economic sanctions, energy prices, and the overall stability of the region. Heightened military action could lead to increased oil prices, affecting global markets and economies dependent on stable energy supplies. Furthermore, any aggressive U.S. move may prompt retaliatory actions from Iran and its allies, escalating tensions further. As the U.S. evaluates its options, the potential for conflict looms larger than ever. The decisions made following this briefing could have lasting repercussions for years to come, as the U.S. grapples with the delicate balance between military readiness and the pursuit of diplomatic solutions. The next steps will be crucial in shaping the future of U.S.-Iran relations. U.S. stock futures have experienced a slight uptick following strong earnings reports from major tech companies, including Microsoft, Alphabet, and Amazon. These firms have reported impressive results, largely driven by the increasing adoption of artificial intelligence tools across various sectors. The surge in demand for AI has transformed business operations, leading to higher revenue streams. Alphabet, in particular, saw its shares rise by 6% after announcing a significant boom in its cloud business, which has become a critical growth area. However, not all tech stocks are performing equally, as some, like Meta Platforms, are facing challenges that have dampened investor enthusiasm. This divergence in performance illustrates the volatility present in the tech sector, as investors remain cautious yet hopeful about future growth. The stock market's performance is a crucial indicator of investor confidence, and with Apple set to release its earnings later today, analysts are eager to assess how these results could further impact market dynamics. A strong showing from Apple could bolster confidence, potentially leading to a more robust recovery in tech stocks and broader market indices. ADP has announced its third-quarter fiscal results, revealing significant insights into the current state of employment and economic activity in the U.S. The company reported solid financial performance. However, it has revised its fiscal outlook due to increasing uncertainties surrounding the labor market. The latest data indicates that while job creation remains a positive trend, the pace has noticeably slowed, raising concerns among economists. Many corporations are resorting to layoffs, particularly in industries heavily influenced by automation and artificial intelligence. This shift underscores a broader transformation in the workforce as companies adapt to new technologies. The implications of this report extend beyond ADP itself. It serves as a critical barometer for wider labor market trends, impacting policymakers and business leaders alike. As the economy grapples with various challenges, stakeholders are closely monitoring these developments to gauge future conditions. Looking ahead, the continued evolution of employment dynamics suggests that businesses will need to invest in workforce reskilling to remain competitive in this rapidly changing environment. The global economic outlook has taken a significant downturn, with many analysts predicting slower growth rates due to rising inflation and ongoing disruptions in supply chains. This troubling situation is exacerbated by escalating geopolitical tensions in various regions, particularly in the Middle East, which are causing fluctuations in energy prices and affecting global markets. Countries that heavily rely on oil imports are feeling the impact most acutely, as prices remain volatile and unpredictable. Governments worldwide are grappling with how to stimulate their economies while simultaneously addressing rising living costs for their citizens, which have reached alarming levels in some regions. In response, central banks are considering adjustments to interest rates and fiscal policies to mitigate these pressures. The international community is left to contemplate how these developments will affect global trade, investment, and overall economic stability. As the coming months unfold, nations must navigate these multifaceted challenges strategically, seeking innovative pathways to recovery and resilience against future shocks in the global economy. In recent reports, the unemployment rate in the United States has held steady at 3.6%, reflecting a complex labor market that is both resilient and challenged. Despite the addition of approximately 180,000 jobs in March, many sectors are experiencing significant layoffs, particularly in technology and manufacturing. This duality presents a paradox where job openings exist, yet many workers remain hesitant to enter the job market due to economic instability and rising costs of living. The Federal Reserve's recent decisions on interest rates have also played a crucial role in shaping employment trends as businesses adjust to evolving economic conditions. Analysts predict that the persistence of this steady unemployment rate may lead to increased scrutiny of monetary policies and their effectiveness in stimulating job growth across various industries. The coming months will reveal whether these trends can shift positively or if additional measures will be required to address the labor market's challenges. Policymakers may need to consider targeted interventions to foster sustainable employment growth. International oil prices have been fluctuating significantly, driven by geopolitical events and changes in production outputs. Recent tensions in the Middle East, particularly involving key oil-producing nations, have sparked fears of potential supply disruptions, prompting traders to react swiftly in the market. This volatility is not merely a financial statistic, it has profound implications for consumers and businesses alike. Higher oil prices can lead to increased transportation and manufacturing costs, which may ultimately result in higher prices for everyday goods. Countries that are major oil exporters, like Saudi Arabia and Russia, are benefiting from these price increases, while nations that rely heavily on imports, such as Japan and many European countries, are facing mounting economic pressures. As the situation develops, analysts are closely monitoring the energy markets for signs of stabilization or further volatility. In the coming weeks, stakeholders will be assessing the broader economic impact of these fluctuations, particularly as winter approaches and demand for heating oil rises. Global supply chain challenges continue to pose significant hurdles for businesses around the world. Disruptions caused by the pandemic, geopolitical tensions, and increased demand for goods have resulted in delays and increased costs. Companies are struggling to balance supply and demand, leading to shortages in various sectors, from electronics to consumer goods. The situation has prompted many businesses to reconsider their supply chain strategies, with some opting to localize production to mitigate future risks. As companies navigate this complex landscape, consumers are also feeling the effects, with longer wait times for products and higher prices. Experts suggest that unless substantial changes are made, these challenges may persist for the foreseeable future. The global economy's recovery hinges on how effectively these supply chain issues can be addressed in the coming months. The technology sector is witnessing a wave of layoffs as companies adjust to changing market conditions and economic pressures. Major firms are reevaluating their workforce needs in light of increased automation and advancements in artificial intelligence. While some companies are reporting strong earnings, others are struggling to maintain profitability, leading to difficult decisions regarding staffing. This trend raises questions about the future of work in tech, as many skilled workers find themselves facing uncertainty. The impact of these layoffs extends beyond the individuals affected, influencing the broader economy as consumer spending may decline. As companies navigate this challenging environment, the potential for further restructuring looms large. The tech industry's evolution will be critical to monitor as it adapts to these ongoing changes. Recent reports indicate a slowdown in GDP growth, raising concerns among economists and policymakers. This slowdown can be attributed to several factors, including rising inflation, supply chain disruptions, and reduced consumer spending. As businesses grapple with increased costs and economic uncertainty, many are revising their growth forecasts for the year. The impact of a slowing GDP could be felt across various sectors, affecting job creation and investment. Policymakers are now faced with the challenge of implementing strategies to stimulate growth while managing inflationary pressures. The coming months will be crucial as the economy attempts to navigate these challenges and regain momentum. Stakeholders are urged to stay vigilant as developments unfold in the economic landscape. Thank you for tuning in today. Which story shocked you the most? Let us know in the comments, and don't forget to like and subscribe for more updates.